future financial wizard? Are you ready to dive into the world of investing, but feeling like you're staring at a complicated menu written in a foreign language? Stocks, index funds, ETFs. It all sounds like jargon, right? Well, guess what? You're in the perfect place. Because today, we're going to demystify the core building blocks of investing, making it simple, straightforward, and actually exciting for beginners. We're talking about investing for beginners, index funds versus ETFs versus stocks, explained simply. By the end of this video, you'll not only understand what these terms mean, but also know which one might be your best first step towards building real wealth. So grab a coffee, hit that like button, and let's unlock your financial potential. All right, let's set the stage. For many, investing feels like this exclusive club with a secret handshake. You hear about people making money in the stock market and you think, how do I even start? The truth is, it doesn't have to be complicated. The goal of investing is pretty simple. Make your money work harder for you so you can achieve your financial dreams, whether that's buying a house, retiring early, or just having more financial freedom. But with so many options, especially these three big players, individual stocks, index funds, and ETFs, it's easy to get lost. We're here to clear that fog. Think of me as your friendly tour guide, simplifying each path. We'll break down each one, explore their superpowers and their weaknesses, and then help you decide which one aligns with your comfort level and financial aspirations. No more guessing games, just clear, actionable understanding. Let's start with the most basic building block, individual stocks. When you buy a stock, you're essentially buying a tiny little piece of ownership in a single company. Imagine you're buying a single Lego brick from a huge Lego castle. You own that one brick. If the company does well, makes more money, innovates, expands, then the value of your piece, your stock, generally goes up. If the company struggles, the value might go down. Think Apple, Google, Tesla. These are all individual stocks you can buy. The appeal? High potential returns. If you pick the next Amazon early on, you could see significant gains. It's exciting, and you get to be directly invested in companies you believe in. But here's the catch. It also comes with higher risk. If that one company you invested in performs poorly or even goes bankrupt, you could lose a substantial portion or even all of your investment in that specific stock. It requires a lot of research, staying updated on company news, understanding financial reports, and having a good grasp of market trends. It's like being a detective for every company you own. For a beginner, this can be incredibly time-consuming and, frankly, pretty stressful. You're putting all your eggs in one basket, or at least a few baskets that you've handpicked. Now, what if you don't want to spend all your free time researching individual companies, but you still want to participate in the stock market's growth? Enter the index fund. Think of an index fund as a pre-made, diversified basket of different stocks. Instead of buying one Lego brick, you're buying a pre-assembled Lego set that contains hundreds or even thousands of bricks, all chosen to represent a specific segment of the market. The most famous example is an S&P 500 index fund. This fund holds stocks of the 500 largest US companies. When you invest in an S&P 500 index fund, you're essentially owning a tiny piece of all those 500 companies. You're not trying to pick winners, you're betting on the overall US economy or a specific sector to grow over time. The huge benefit here is diversification. If one or two companies in the S&P 500 perform poorly, it has a minimal impact on your overall investment because you own so many other companies. This significantly reduces your risk compared to individual stocks. It's passive investing. You set it and largely forget it. You don't need to constantly monitor individual companies. They also typically have lower fees than actively managed funds. The downside, you won't outperform the market. If the S&P 500 goes up by 10%, your index fund will go up by roughly 10%. You're not going to pick the next Amazon and get a 1,000% return from a single stock, but you're also not going to lose everything if one company collapses. It's a steady, reliable approach, often recommended by investment legends like Warren Buffett for most people. Okay, so we have individual stocks for the adventurous and index funds for the diversified and passive. What if there's a middle ground offering diversification, but with a bit more flexibility? That's where exchange-traded funds, or ETFs, come into play. ETFs are like cousins to index funds. Many ETFs are index funds, meaning they track a specific index like the S&P 500. But the key difference is how they're traded. ETFs are bought and sold on stock exchanges throughout the day, just like individual stocks. Imagine your diversified basket, the index fund, now has a barcode and can be traded instantly, multiple times a day. This offers a lot of flexibility. You can buy or sell ETFs at any point during market hours, whereas traditional index funds are typically traded only once a day after the market closes. ETFs also offer more variety. While many track indexes, there are also ETFs that focus on specific sectors like tech or clean energy, commodities like gold, or even bonds, so you can get very specific with your diversification. They combine the diversification benefits of an index fund with the trading flexibility of a stock. They often have low expense ratios, similar to index funds. The potential downsides, because they can be traded throughout the day, some people might be tempted to day trade them, which can lead to overtrading and higher transaction costs, eating into your returns. Also, while their fees are generally low, some niche ETFs might have slightly higher expense ratios than broad market index funds. But for most beginners, they offer a fantastic blend of diversification and accessibility. So, individual stocks, index funds, or ETFs? How do you choose? There's no single best option for everyone. It really depends on your financial goals, risk tolerance, and how much time you're willing to dedicate. If you're someone who loves to research, enjoys the thrill of picking individual winners, and understands the higher risk involved, then individual stocks might appeal to you. Just remember, it requires significant dedication and acceptance of potential losses. If you're a beginner, want broad market exposure with lower risk, and prefer a set-it-and-forget-it approach, then index funds are often the gold standard. They're fantastic for long-term wealth building with minimal effort. And if you want the diversification of index funds, but with the added flexibility to trade during the day or to invest in more niche sectors, then ETFs are a superb choice. Many beginners find ETFs incredibly approachable and a great way to start diversifying immediately. My advice for most beginners, start with broad market index funds or ETFs. These offer instant diversification and significantly reduce the risk compared to picking individual stocks, giving you a solid foundation without overwhelming you. As you gain more experience and knowledge, you can always explore individual stocks if you feel comfortable. The most important thing is to start investing consistently. Even small amounts invested regularly can grow substantially over time, thanks to the magic of compound interest. Don't wait for the perfect moment. Start now. All right, financial rock stars, we've officially demystified the core building blocks of investing: individual stocks, index funds, and ETFs. You now have a clear understanding of each, their benefits, and their potential drawbacks. Remember, this isn't about getting rich overnight, but about consistently building wealth over time. The most important step is the first one, and you just took a huge leap by educating yourself. Which one are you leaning towards? Let me know in the comments below. I'd love to hear your thoughts and help answer any follow-up questions you might have. If you found this video helpful, please give it a big thumbs up, share it with a friend who's also looking to start investing, and of course, subscribe to the channel for more straightforward financial wisdom. Remember, your financial future is in your hands, and you're already on your way to mastering it. Keep learning, keep growing, and I'll see you in the next video.